One of the best ways to secure your financial future is to invest, and one of the best ways to invest is over the long term. It may have been tempting over the past few years to deviate from a long-term approach and chase quick returns. But with the market's current high valuations, it's more important than ever to focus on investing for the long haul while sticking to your game plan. Investors today have many ways to invest their money and can choose the level of risk that they're willing to take to meet their needs. You can opt for very safe options, such as a certificate of deposit, CD, or dial up the risk and the potential return. With investments such as stocks, mutual funds, or ETF, or you can do a little of everything, diversifying so that you have a portfolio that tends to do well in almost any investment environment. So before going deeper into the video, make sure to subscribe to our channel and press the bell icon for more videos. So let's get started. Number 1. Growth stocks. In the world of stock investing, growth stocks are the Ferraris. They promise high growth and along with it, high investment returns. Growth stocks are often tech companies, but they don't have to be. They generally plow all their profits back into the business, so they rarely pay out a dividend, at least not until their growth slows. Growth stocks can be risky because often investors will pay a lot for the stock relative to the company's earnings. So when a bear market or a recession arrives, these stocks can lose a lot of value very quickly. It's like their sudden popularity disappears in an instant. However, growth stocks have been some of the best performers over time. If you're going to buy individual growth stocks, you'll want to analyze the company carefully, and that can take a lot of time. Number 2. Stock funds. If you're not quite up for spending the time and effort analyzing individual stocks, then a stock fund, either an ETF or a mutual fund, can be a great option. If you buy a broadly diversified fund, such as an S&P 500 index fund or a NASDAQ 100 index fund, you're going to get many high-growth stocks as well as many others. But you'll have a diversified and safer set of companies than if you own just a few individual stocks. A stock fund is an excellent choice for an investor who wants to be more aggressive by using stocks, but doesn't have the time or desire to make investing a full-time hobby. And by buying a stock fund, you'll get the weighted average return of all the companies in the fund. So the fund will generally be less volatile than if you had held just a few stocks. Number 3. Bond funds. A bond fund, either as a mutual fund or ETF, contains many bonds from a variety of issuers. Bond funds are typically categorized by the type of bond in the fund, the bond's duration, its riskiness, the issuer, corporate, municipality, or federal government, and other factors. So if you're looking for a bond fund, there's a variety of fund choices to meet your needs. When a company or government issues a bond, it agrees to pay the bond's owner a set amount of interest annually. At the end of the bond's term, the issuer repays the principal amount of the bond, and the bond is redeemed. A bond can be one of the safer investments, and bonds become even safer as part of a fund. Number 4. Dividend stocks. Where growth stocks are the sports cars of the stock world, dividend stocks are sedans. They can achieve solid returns, but they're unlikely to speed higher as fast as growth stocks. A dividend stock is simply one that pays a dividend, a regular cash payout. Many stocks offer a dividend, but they're more typically found among older, more mature companies that have a lesser need for their cash. Dividend stocks are popular among older investors because they produce a regular income, and the best stocks grow that dividend over time, so you can earn more than you would with the fixed payout of a bond. Rates are one popular form of dividend stock. Number 5. Value stocks. With the market running up so much in the last couple years, valuations on many stocks have been stretched. When that happens, many investors turn to value stocks as a way to be more defensive and still potentially earn attractive returns. Value stocks are those that are cheaper on certain valuation metrics, such as a price-earnings ratio, a measure of how much investors are paying for every dollar of earnings. Value stocks are contrasted against growth stocks, which tend to grow faster and where valuations are higher. Number 6. Target date funds. Target date funds are a great option if you don't want to manage a portfolio yourself. These funds become more conservative as you age, so that your portfolio is safer as you approach retirement when you'll need the money. These funds gradually shift your investments from more aggressive stocks to more conservative bonds as your target date nears. Target date funds are a popular choice in many workplace 401k plans, though you can buy them outside of those plans too. You pick your retirement year and the fund does the rest. Number 7. Real estate. In many ways, real estate is the prototypical long-term investment. It takes a good bit of money to get started. The commissions are quite high, and the returns often come from holding an asset for a long time, and rarely over just a few years. Still, real estate was Americans' favorite long-term investment in 2021, according to one Bankrate study. Real estate can be an attractive investment, in part because you can borrow the bank's money for most of the investment and then pay it back over time. That's especially popular as interest rates sit near attractive lows. Number 8. Small cap stocks. Investors' interest in small cap stocks, the stocks of relatively small companies, can mainly be attributed to the fact that they have the potential to grow quickly or capitalize on an emerging market over time. In fact, retail giant Amazon began as a small cap stock and made investors who held on to the stock very rich indeed. Small cap stocks are often also high growth stocks, but not always. Like high growth stocks, small cap stocks tend to be riskier. Small companies are just more risky in general, because they have fewer financial resources, less access to capital markets, and less power in their markets, less brand recognition, for example. But well-run companies can do very well for investors, especially if they can continue growing and gaining scale. Number 9. Robo-advisor portfolio. Robo-advisors are another great alternative if you don't want to do much investing yourself and prefer to leave it all to an experienced professional. With a robo-advisor, you'll simply deposit money into the robo account, and it automatically invests it based on your goals, time horizon, and risk tolerance. You'll fill out some questionnaires when you start so the robo-advisor understands what you need from the service, and then it manages the whole process. The robo-advisor will select funds, typically low-cost ETF, and build you a portfolio. Number 10. Roth IRA. A Roth IRA might be the single best retirement account around. It lets you save with after-tax money, grow your money tax-free for decades, and then withdraw it tax-free. Plus, you can pass that money on to heirs tax-free, making it an attractive alternative to the traditional IRA. So that's it for today's video. I hope you liked this video. If you really want to, then do not forget to subscribe to our channel and hit the bell icon for more videos. Thanks for watching and have a wonderful day.